Rohr here with a very concise highlight on Thursday, September 11th, 2014. It is currently 7:45 a.m. The reason it is going to be so concise is that so much is still consistent with the extensive equities and fixed income coverage along with the Asian foreign exchange from Wednesday morning's concise highlight. And the rest of foreign exchange is still very consistent with the global view from Tuesday morning. So if you need anything on either of those, we encourage you to look back. But this morning we're only covering the S&P 500 because it's the one that's in the most critical position. Moving on to the actual activity in the market, though, the S&P 500 is off $8 this morning, and we have to allow that it only dropped back below 1990 to 88, that key level we were pointing out yesterday on that head and shoulders pattern. We only dropped below it after the U.S. weekly jobless claims. So it does appear a bit of bad news is weighing on the market, but it had been down at 1985 earlier electronically. So it's back up a couple bucks from there. And just to revisit the importance of this based on looking at the hourly chart and the head and shoulders pattern that had formed there out of the gap higher back on Monday the 25th, you'll note that it was once again kind of an awkward pattern, kind of a modest left shoulder, a very distended, distorted sort of head, into a little bit more prominent right shoulder. And we had even said yesterday morning, as the market was down on this down break from Tuesday, that the burden of proof was on the bears to get this rolling in a more major way on the downside, especially in light of the hourly MACD being down around the lower runaway band and trying to prevent an upturn in the hourly stochastic. And instead what we got is the squeeze back up yesterday. Now, this means on the current dip, the market is even in more critical territory because you do allow for a clean out back against the breakout, in this case against the down breakout. You had the squeeze above it to the upside, and now we're kind of right back down in this area. And of course there's not quite as much risk that the hourly MACD will immediately drop out into a more aggressive downside pattern, and we do have the gap going back to the mid-morning yesterday where the market gapped up from 1986. So that's another key level we need to keep an eye on here. Can the bears, now that they've managed to restrain the market, put it back under pressure, really get it going on the downside again? And that's going to be the operative question today. And there is also the issue of the 30-minute, more sensitive MACD, of course, will be back under pressure. It'll be seeming to give a down signal. The bigger indication, the 30-minute stochastic, and the bigger issue for us on the stochastics will be whether the 60-minute stochastic ends up crossing back over in a down signal or just starts to steady off around 50 or so. We shall see. That pretty much does it for the short-term view of the S&P 500.